This video will hopefully change the way you look at dividends. It seems like they're just there to boost your overall long-term gains, but I will show you how you can get a dividend for free, or in the worst case scenario, get your favorite dividend stock for 5% cheaper. Hey, my name is Ivan and I've been doing options for 6 years. I've learned why they're so complicated and I want to make them so simple that every single retail investor can just use it daily. So let me just show you how you can do this on your own. For now, let's take a look at this dividend for UNH as our example. They have an ex-dividend date this Monday, and what this actually means is even if you bought the stock on Friday right before close and you still keep it on Monday before it opens, you will be getting $2.21 for every share you own. That's around 0.6% gain just in that one day. It seems like it's a free way to get money, but because everyone knows this, the stock will drop for exactly $2.21. If you try to short it, like and making a profit from that, it doesn't work because if you're short in the stock, you are actually responsible to pay out those dividends. So, okay, what's our edge here? Um, it does not work because if you buy it right now, your cost basis will be higher than the future price of the stock after dividend gets paid out. So what you have to figure out is how can you get your cost basis lower than the current price and the future price and then own the shares to get those dividends on Monday and be eligible. For that, we have a trick with covered calls. I'll just quickly switch to the options chain for UNH, and this is very standard. We'll just take a look at two strike prices that you can see here right in the middle. I'll take a look at the 347.5 strike price. It's and it currently is worth around $8.7. Most likely you can get it for. So if I sell a call for this strike price that it's currently like below, it's in the money, I am obligating myself to sell 100 shares of UNH for this price. And I will be collecting a premium of $8.7 for every share, meaning 8.7 times 100, $870. So it seems like on paper, I have to buy stocks for 352.5 and I will be selling them for less than they're currently worth, so 347.5. So I'll be on paper taking a loss of $500, but because I sold a covered call for 870, I'm actually making a difference of around $370. So that's how covered calls work. We can take a look at two of these strike prices. Yeah, we are looking at September 19th and 375, and also we are looking at 340. I've already taken the values of these two options we're going to compare. The first one is 375.5 that we already took a look at. It has an intrinsic value of $5. Why? Because the stock was 352.5 after hours. So it's actually just the difference between 352.5 and 347.5. It's $5, which means the rest of this $8.7 premium goes towards the extrinsic value of $3.7. So comparing that to the 340 call, which was worth about $13.9, it only has $1.4 of extrinsic value. And I'll get into just a moment why this is important. Well, the dividend is $2.2. In both cases is obviously the same, but on this covered call, the extrinsic value is greater than the dividend. And in this case, the dividend of $2.2 is lower than the dividend rate. What this tells you is because we've given the right to someone to get our shares for this strike price, in one case, most likely they will actually exercise that option and our shares will get assigned and get called out. So basically, if the stock is, if we sell a 340 covered call, it will be financially feasible for someone to actually exercise it from us on Friday before close, um, because the extrinsic value of that option is only $1.4, and that's less than the actual dividend they will collect. So in this scenario, you'll most likely say goodbye to those shares. You will not see the dividend. In the left scenario, yes, the strike price is a bit higher, so like you're taking a more risk, but you will most likely see Monday with your shares still in your account. So in this case, you will collect a dividend. In this case, you will not collect a dividend. Even though you're not collecting a dividend, you are earning this extrinsic value. Why? Well, because you had to buy 100 shares of UNH, so that will be $35,250. But you will be, so that's negative out of your account, but you will be getting $34,000 because that's your strike price, and you will be getting $1,390 as a premium. So in total, you'll actually profit around $140, which is exactly the extrinsic value of the option. That on its own is already great. You're basically in one day just getting 0.4% return on your investment. That's amazing. But you will not be collecting a dividend. And the second option can be more powerful, but you have to be okay with a scenario where the stock actually goes down and below your strike price. All right, those are two scenarios that can happen. And depending on your appetite of actually owning a stock versus trying to just get that 0.4% in one day, it determines which covered call are you actually selecting. Let's take a look at the scenario on the left. So let's say I'm actually gonna sell the 375.5 call. And I think in some cases you will actually get assigned and you'll get 1% in Monday, which is great. But in most cases, you will just wake up on Monday and still have your 100 shares in your account. And you will also be eligible for a dividend. So let's break down the math in this scenario. Yes, you will be collecting those $8.7 that you got as a premium for your covered call. But you will also get additional $2.21 from the dividend. So in total, you're almost getting $10 in total. And yes, you might get assigned, but in that case, you're still making an awesome profit. So you'll basically then be your profit will be $3.7 from this extrinsic value that we've determined here, plus the dividend of $2.2, which is around $6. That's actually 2% return in just 1 week. So if the stock stays above your strike price, so above the 347.5, this is going to be your total profit, basically $600 or 2% in just 1 week. In case that stock does crash and it goes below your strike price, so in case that the stock actually does this, which is likely possible, this is still okay because you collected $10 in this whole transactions, and your cost basis was $10 lower than the price on Friday. So basically, you bought UNH for $352.5, but you actually collected $10 in these transactions. So your cost basis will be $342.5, or roughly like 3.5% cheaper. So this is the worst case scenario. that you have to be ready for, and that's why you select the stock that has a dividend and you do kind of like. In this case, Warren Buffett just bought UNH, and it seems like it has solid fundamentals, even though it's been through a rough time. But with this strategy, the worst that can happen is you get the stock you like for 3.5% cheaper than it is on Friday. That's very unlikely because on Monday, what's gonna happen is, yes, the stock will go down $2.2 and you were long that stock, but your call will also drop, maybe not $2.2, but it might drop $2 in value, and you were short on that call. So in total, you will collect the dividend for free and you're going to close the position on Monday market open. Unless the stock really crashes below your strike price, you will be able to close the position, that pair of 100 stocks and a cover call, for roughly the same cost basis that was you actually entered it for. So you will, let's say you've entered for a cost basis of, as we mentioned here, 342. You will most likely be able to close that for $343, slightly higher than you actually been, but you've collected $2.2 in dividends, so you don't mind that scenario. So you basically collected a free dividend that day for a very, very cheap premium. Maybe you're gonna pay $50 extra to close the position, but you've collected $220 as your dividend. So there you have it. Basically, in any scenario, you win. It's either you get assigned and you collect that 0.5 to 1% in just one single day. You either don't get assigned and collect additional premiums and dividend, so you can close the position right on Monday. Also, amazing return in just one day. Or the stock really tanks and you got it for almost 4% cheaper just by doing this strategy. So yes, you have to be ready for the worst case scenario, but in 25% cases, in my experience, you just get the profit and get assigned in just that overnight period. This does work with most dividend stocks, but there are few criteria you have to be aware of. One is just you want some liquidity. You don't want like huge spreads on the calls. And yeah, you do want some volatility and some previous volatility in the stock, so you can make sure that extrinsic value is worth your time and worth dealing with the stock. So maybe I can also share how it actually looks like in my Fidelity. There is built-in buy right option here in Fidelity. So I just click on sell, the option we like. And if you look at here, you just do buy right, which is actually buy the stock, and sell an option. So I just enter 100 shares, which is automatically going to calculate as one call. It expires this week, and I just select the strike price. So we, let's say we go with this strike price. It will automatically calculate your cost basis. So 344, that's almost $10 lower than the current stock price is, and it will show you your max gain and max loss. So yeah, as I mentioned, on Monday, most likely I'll be closing that for, let's say 344.8, and I'll still be keeping my dividend. All right, there is one more thing I wanted to share here is how do you actually get exposure to all of these options, and how do you compare them? So in QuantWheel, we here just have UNH and buy right strategy, and it's going to list out all the options that are kind of viable for doing this thing, and it will list out exactly what the yield and how it looks like on the yearly basis prorated. So in this case, we sold 347. If you actually do get assigned, it's going to be 0.9% gain, similar to what we calculated. And this actually gives you 50% yearly profit if you do this every single week on your favorite stocks. So thank you for watching, and let me know down in the comments if you would like to receive any notifications on the dividend stocks and the covered call strategy I'm using.